So hello everyone, welcome to this Silicon Valley Innovation Center interview. Very glad to have you with us. We are coming to you live with me, your host Rahim Rahimtullah, and my guest today, who is Pierre Rogers. He is the founder of PuroTrader, and he's also a venture capital investor. So Pierre, it's great to have you with us on this live SVIC interview. I'd like to start, if I may, because we're talking about VC today, venture capital, venture investing. And when I look at the tech or the business news pages recently, I would say a lot of the stories I see there are about how some of the biggest names in tech are going to be going public very soon. So maybe this year or next year. And I'm talking here about Lyft, Slack, Uber, Pinterest, Airbnb. They've all been in the business and the tech pages recently for this because they're going to go public. And the story I see here is that these are old, as it were, first generation big unicorns. We say, the $1 billion companies, and they're going public. And so those industries are not going to be disrupted in the same way as they have in the past. And those $1 billion opportunities in accommodation, in taxis, those are not going to come around again anytime soon. So if you're a venture investor, you're looking for the next big opportunity, the next big unicorns. One idea goes that these are going to come from more narrowly focused software companies. So ones that are looking at a specific industry, for example, software companies which can help agriculture take advantage of big data. That's a very sector specific case, but that could lead to the next big opportunity. So Pierre, I want to just start with that as an opening salvo. What do you think about that as a VC? Does that correspond to the picture that you see out there in the world?
I think that's a great short-term view as to what's happening within venture, right? As you described it, some of these early-stage unicorns have really taken off, and they're now multi-billion-dollar companies. Let's add a little context to that. When Apple originally IPO'd, it IPO'd at $100 million market cap. Lyft and Uber, their combined market cap, and I bring them up because they may IPO around the same time, will be $180 billion. Right. So said differently, so much wealth creation has happened now in the private markets, where a long time ago, 30 years ago, it was all in the public markets. So from a short-term perspective, I 100% agree with you. You're going to find these niche businesses. Myself, it falls a victim to this, a very niche business for what PuroTrader does. But you're going to see that more and more. However, longer term, there are still many more disruptive industries to happen. For instance, space is the new frontier. We've made some investments in space in various angles of that. That is ripe for change and sort of mass unicorn building if you can find certain ways to attack that. I think of Dr. Peter Diamandis with the X Factor, right, and mining asteroids for rare earth metals. And they're profitable, right? So it sounds kind of futuristic sci-fi, but they're actually making money. So short term, I agree. Metadata, agro makes a lot of sense. It's a great kind of 3 to 6 year business plan if you're a VC investor. And we're very much community niche based, and we think you're going to see lots more of that. There's rumblings in the spirits industry as bourbon and scotch and this type community, the value of those items has gone through the roof. And so there's these niche collector markets that have taken off. Agree with all that. Longer term, though, there's still plenty of big opportunities that are sort of in mass or will positively disrupt large parts of the population.
And that's interesting. And you talk about space. I mean, I think we all sort of think about space. One of the headline companies we think about there are the ones who are pioneering in passenger space flight. But I think that's just the ones we hear about. But by the sounds of things, there's a lot more going on there, potentially with consequences for industry and so on, business, more like business focused stuff, which we as consumers may not be aware of.
Right. So one portfolio company I recently invested in, they use a version of sonar in satellites to ping back down to the United States to get real-time imaging regardless of weather patterns. So of course, we've done that with radar and images in the past, but with sonar, it doesn't matter if there's fog or cloud cover or any weather patterns disrupting it. You can always get a highly accurate image in real time. And so that's been actually a fantastic investment for us. Think about that. You can have satellites whizzing around up there that are giving you real-time data on everything that they're sort of photographing, for lack of a better term, below. We've never been able to do that before. So there's a kind of an interesting space investment that is and is not a space investment, for lack of a better term.
Sure. Isn't something like that, Pierre, isn't it a bit difficult, though, for you as a VC to assess how good an opportunity that is? Because if someone said to you, look, I have this app for taxis, I have this app for accommodation, it's pretty self-explanatory. It's very intuitive that could be a game changer, and that could be something really incredible, which could generate huge returns. But when you look at something like space, or when you look at something like data analytics in agriculture, if you're not a specialist in these things, does that not create a difficulty there to really look at it and understand, is it a good opportunity or not?
I will say that may be the single hardest challenge that we in the VC industry have. So I could go on and on about our process and due diligence, and Kleiner, they've got a great due diligence program, and so does Sequoia and many of these other phenomenal venture shops. But at the end of the day, you're making a bet on the team, and you're making a bet on that individual. And that's really hard to do, because you can't just say, well, this person went to a good school, so clearly they're smart and they have a high SAT or something silly, some arbitrary measuring stick, thus they'll be successful. Because honestly, when you look at most of the unicorns that are out there, many of them didn't go to great schools, right? They're founders, that is. They didn't go to great schools, and they may or may not have a high SAT score or IQ, but yet they have this thing inside them. Is it tenacity? Is it grit? Is it creativity? Is it creative problem solving? I would say yes. It's yes to all of those things. And so really one of our jobs is, does the business make sense? Is an addressable market? How is the minimum viable product, right? All the cliche words we're supposed to use as we go through that process. But at the end of the day, any of these cutting edge businesses that are going to be disruptive, they're going to bump into challenges that you just don't see coming and you can't plan for. Okay, then you're betting on the guy or the gal that's leading that. And do they have what's in it for them, the tenacity, the creativity to come around that, right? So the universe, or whatever you want to call it, will put obstacles in your way. It is oftentimes those obstacles that actually become the successful way out.
And do you over time get better at assessing that and recognizing that in people? I mean, I know you, and we'll maybe talk about this a little as well. I know you have your own business and you went through obstacles to make that happen. Is it a case of, for example, seeing a potential founder there who wants some investment, and you say, oh, I recognize myself in them, for example? I mean, do you have to have trod that path yourself in order to, understand what you're looking at?
When you look, that's a very good question. I would say one of the things that has made me a successful venture capitalist, I would say the thing, is the fact that I went through the entrepreneurial journey, not just once, but a few times. Some of it was successful, some of it was not successful. And it's actually in experiencing both sides of that allow me the ability to connect with the founder and entrepreneur much, much better. We speak the same language. We've been there in those sort of dark and difficult times. But it all recognize the patterns both within myself that these founders have, that I go, okay, they have it, whatever the it factor is, right? The esoteric it factor, do they have it or not? And it's through that pattern recognition of A, going through it, but B, doing it over and over and over again, that it helps me source and understand better that entrepreneur. And if they have it in them to get up early and work hard when everything is against them and sort of everything is failing? Do they have that self-awareness in them to go, hey, my business isn't working over here, but what if I pivot over here? What does that look like? That takes, right, to give up what you sort of started with and be able to pivot. So there's different personality traits that I look for in that process.
Mm-hmm. And when I'm speaking of personalities, I wonder, what is your feeling on the personal relation of a founder to the problem that they're trying to solve? Because I see this as a sort of perhaps a debate, if you will, in VC, where some believe that in order for a company to be successful, the founder needs to personally have experienced the problem that they're trying to solve. You can't just be a smart person looking for a problem to solve. You really need to know it yourself and have experienced that pain in order to make a successful business out of it. And again, I know you're a cigar enthusiast and your business is in cigars. And so I wonder, would you be willing to back yourself to turn to another industry, another sector? Or do you feel like that personal link and experience you have is crucial?
I think it is crucial. I think it's incredibly crucial. And I think that one of the problems that the media and Silicon Valley have sort of perpetuated this myth, which is you get smart people that go, hey, go find and solve a problem, and that's the business. Now you've got a lot of people trying to solve problems that aren't really that big of a deal that no one really cares about, right? And that doesn't business. That just creates somebody working on a project. Those are sort of two different things. And that if it's your problem, you've experienced the pain, then you are in a unique situation to go, I'm a first customer, number one. I can look at this business very differently because I'm their number one customer. I have this problem. And most likely, if you have that problem because you've experienced it, there's a good chance there are many other people like that. Quick story about another portfolio company that we invested in. Send a Ride is the name of the company. They are effectively a Uber or Lyft type service, but they're specifically made for people who need to get to medical appointments. Okay. And that means they have drivers that have background checks, that have credit checks, that are not expected just to pick someone up and drop them off, but they're actually there to help you from your home into the vehicle, from the vehicle to your doctor, check you in, help pick up a prescription, right? So this is particularly important if you're either disabled, i.e. you've taken a pain medication or you have casts on or what have you, or if you're elderly, for instance, right? We're not talking about just wheelchair-bound folks, but if you're elderly and you can no longer drive or what have you, you need someone to take all of your appointments. This is incredibly impactful in a business that's disrupting that space, because prior to this, there really wasn't anything. Uber and Lyft are ill-equipped to take that customer, and thus that person would be really relying on their friends and family to carry that burden. And it is a burden. And so that is something that the founder experienced herself when she was perfectly healthy lady. She ended up getting in a car accident, was debilitated, had to go to physical therapy and other things, couldn't drive, on pain medication and pain. So she had this experience. She's uniquely qualified to build that business because she understands that pain point and has done a phenomenal job.
Yeah, interesting. Thank you. That's very interesting, Pierre. And I wonder if we just maybe step back a little. Let's think about VC as an industry, as a concept, as it were. I ran across some data recently from CBI Insights. They found that venture capital investments in the United States, into US companies, had gone up to $99.5 billion in 2018. And this was the highest level that they had found since 2000. And so I look at that and I think, okay, it's a very healthy industry, business as usual, things are going well. But I do read as well about alternatives to VC, about how certain founders, certain companies don't like the VC model that we see today in Silicon Valley, especially. They don't like this idea of hyper growth, that growth above all is what we strive for. They'd rather do things a little more slowly, make sure that they can earn what they need to reinvest back into the business and grow it in a more potentially sustainable way. I wonder what your thoughts are on this one, Pierre. I mean, I think this is still a very small percentage of this sort of alternative types of VC. But can we talk about changes in the VC industry? Is a disruption too far of a word to go at this stage? Do you see that happening?
So I encourage that to happen, as a matter of fact. So in venture capital land, we look for exponential growth, right? We look for that hockey stick approach to the growth of a particular company, because most venture firms are looking for an exit. They're looking for that exit as soon as 3 years. Most of us are looking for 5, 6, 7 years, right? Which is why your average venture fund has a 10-year lockup, because historically speaking, from your Series A round to your liquidation or liquidity event, call it an acquisition or what have you, is typically 7.2 years on average. So most venture funds have a 10-year lockup. Is because of that. Gives you kind of a wiggle room. Now, the problem with that is it puts an enormous amount of pressure on the founder and the C-suites that they've got to get in this hyper growth mode, right? Growth at all costs. And oftentimes you can bump into problems. So to point fingers here, Uber has been a prime example of a phenomenal growth company that's had its fair share of problems between the CEO and frankly many of the C-suite executives, right? There was a kind of a joke that Uber was the first self-driving company, because they had no C-suite executives. And some of that was from the pressure of this sort of hyper growth. Then you look in a different direction. You look at a base camp, right? That David runs. They've had one investor. It was Bezos. He invested early on. They've grown very linearly. They have an incredible business model, a lean team, throw off a ton of cash flow. It's been wildly successful. I would argue that long term is a much more sustainable way to get there. So I'm actually a big fan of that, even though it sort of flies in the face of what I do currently. I think that is slowly becoming a trend. Let me put it a different way. Becoming an author these days, writing a book, is the easiest it's ever been. The problem is, you write a book now, there's a million other people who've written a book, and cutting through that noise can be incredibly difficult. It's no longer 5 major publishers that publish you. You could do it yourself, right? So how do you sell a book if there's a million people creating millions of books every year? There's so much noise, there's so much competition. Even if your content is phenomenal, cutting through that noise can be very difficult. And so what we've seen authors do, this is kind of a micro case of what you're talking about, is they'll start a blog, social following around their thoughts, right? Being a thought leader or a fiction writer or biographer, what have you. Then when they go to release that work, they've built their own audience, and it's much easier for them to sell into. Yeah. Now, that's a micro case, but you can apply that story to any business that focuses on one particular niche, right? As a way to have that niche actually be the marketing engine to drive it out, i.e. you might not need either venture capital dollars at all or less venture capital dollars, right? Give up less equity in terms of a founder to be able to grow a little bit more linearly and more long term.
And so do you mean, so a company should start a blog, do you mean, or is there something corresponding for a company? For an author, it's a blog. For a company, there might be other ways to sort of generate that audience.
Right. That's exactly right. So let's take a completely different example, right? Dollar Shave Club.
Yeah.
It started on a viral video. Right, it was a funny video about how expensive Gillette is, effectively, right? Commercial razors work, and so
it's okay. Just for anyone who may not know, Dollar Shave Club, this is a sort of razor blades as a subscription now, isn't it? It's just recurring, sending you razor blades, and it's just a sort of recurring payment. Yeah,
right. And so they made a clever video on YouTube that was funny, addressing that market. Didn't take themselves seriously at all, and from that one video, it got picked up. People loved it. They started subscribing to that service, and off they went, right? And so you think, well, what's sexy and cool about razor blades? Well, you can actually make it that way. You don't have to write a blog about razor blades, right? There's other outlets to get your story out there, to build an audience around your brand, your company, your product, whatever it might be. It is possible. Dollar Shave Club is a great one in that context. Ultimately, they took on venture dollars later, which means the founder got to keep more money. They sold for a fantastic valuation in an incredibly short period of time, right? 0 to north of $1 billion in 5 years. It's just an incredible journey.
Yeah. That's interesting. And Pierre, a lot of our clients at SVIC are corporate clients. So they come from established businesses, and they're looking to innovate on their products and keep up with startups. What lessons do you think, what we just talked about, this potential to go a different way from VC, what lessons do you think it might have for corporate companies, large corporations who want to partner with startups? I mean, when they're looking at startups and how they work with those startups, should they potentially then give startups more time? Should they not sort of necessarily, put so much pressure on them? I mean, how does that work, do you think, in a corporate environment when it comes to partnering with startups?
So I speak a lot about this specific subject. So I travel around the world, mostly in the United States, and speak at large corporate functions, specifically talking about how to attack difficult problems. And many of the ways that large corporations do that is, as you mentioned, partnering with startups or sort of incubating startups in a lot of way, right? And one of the things that I advise them to do, both the startup as well as the sort of mothership, the larger corporation, is to ask why they are trying to solve the problem, and why do they have the problem in the first place. So said differently, there's a certain protocol, a certain way that we all sort of solve particular problems, and it's often done because that's been our experience, and we're often taught, well, that's how it's been done. That's how it's been done, is often the kiss of death in any business. And you need to fundamentally question why that is. Now, the fastest way to skip to the last chapter of this book is to literally look at how it's been done and do it the exact opposite way, right? That's a great way to test why you do it that way, whatever that sort of traditional method to solve that problem is. And if you can do that, the output of doing it the exact opposite will often be really effective in you understanding the problem. Either it'll solve the problem, or it will have told you why that problem can't be solved in that way. Now, that may sound a little obvious, but unfortunately, very few corporations are willing to take the risk in doing that. So what I advise is, when you're partnering with a startup, you need to allow those smart, beautiful, creative people to take risks, to be counterintuitive. Give them the leash in order to do that. You hired them for that ability. Don't bring them into your ecosystem and try to train them to be more like your large corporation. That's the opposite of why you hired them. You should have just hired some employees in that case, right? So it is a unique thing. It's not necessarily time. It's not necessarily money. It's actually giving them the leash to be able to do things in a very unorthodox manner.
And but you do ultimately believe that it can be a fruitful partnership between corporates and startups. You've seen examples of this, I assume?
Over and over and over. So I'll give you a big example of this. 2 companies, small startup, founder lived in a tiny 400 square foot apartment, slept on the floor, was creating a software-based system for file sharing in mass and bulk. And then there's another company, we'll call them Google, that had all the money in the world, right? That had all the resources, the best engineers, the best brand, and they both tried to launch this thing. One launched G Drive, and the other one launched Dropbox. By all intents and purposes, academically, Google should have won that race. Far more money, far more engineers, but they didn't. They lost. And Dropbox won, a much smaller company without the capitalization, without the skill set that Google had. How did Dropbox win? Well, they did it because they were more creative. They wanted it more. They were singularly focused on one problem. Google had G Suite. G Drive was only part of the G Suite. They took their eye off the ball. They didn't execute well. Google learned a very painful lesson, which is they could have just partnered with an early startup and brought those Dropbox guys in, let them be experts in that niche. Instead, they tried to do it themselves. It obviously didn't work. Dropbox ultimately goes public at a fantastic valuation. So there's an example of them not doing it and it being a very painful lesson. Since that time, we have seen Apple and Amazon and many of the FANG stocks actually do the opposite, right? They're starting to understand, hey, we're going to hire this small startup. We're going to acquire them or incubate them or what have you, because they're very powerful in this one niche that we need to be better at, and it can add value to our business. And what you've seen is the IPO market has actually weakened, but the acquisition market has gone through the roof, right? As you're seeing, Amazon, for instance, is kind of known as acquiring these small niche startups and integrating them into their overall platform. So I actually think this is long-term the trend that VC is going to have, right? It's going to look very, very different in that landscape.
And it's interesting, Pierre. I think what you were describing, I think I might have heard the term open innovation used to sort of describe this process where a company needs to be able to leverage internal resources, but also be humble enough to look externally as well and be able to have the processes in place to actually be able to bring in that innovation and make it work effectively. It sounds, it's a tricky thing to do, is it not?
I would challenge that and say it's one of the hardest things to do. So let me use a good quote here. Socrates was the wisest man because he knew he didn't know everything. The issue is when you have a large corporation that has a large C-suite and big board of directors, and they're all very accomplished and very smart, for them to be self-aware enough to go, hey, I don't know how to solve every problem, and I'm going to allow this sort of young upstart team to come in and be an experiment effectively, that takes a lot of guts, right? Because that group of people has to say, hey, we don't know how to solve this. we can't just hire for it. We can't just throw money at it. It's going to take more than that, as we've seen. So that is incredibly, incredibly tricky to do.
And Pierre, we're almost out of time, unfortunately. But if we sort of draw things to a close, I wonder if we can look at the term or the word risk and get your views on risk, because I think it underpins everything we've been talking about. Whether it's corporate venture capital looking to partner with startups, whether it's you as a VC looking at what new opportunities might be out there. What is your attitude to risk? Because you've got to be good at taking it, and you've got to be good at letting failure happen too. So how do you do that? How do you develop those skills, and how do you live with that risk on your head all the time?
So I am a huge proponent of risk. I am always telling people to take bigger risks, swing bigger. We suffer far greater in our mind than we do in reality, right? That was Seneca's favorite quote, right? We suffer more in imagination than in reality. And that's because in our minds, we make up like, oh my gosh, we're going to fail at this thing. And when we fail, it's going to be apocalyptically bad, and I'm going to be homeless, and it's going to be terrible. When actually in reality, that's just simply not true. That's simply not true. That you can look throughout history and the amount of people that have failed over and over and over and over again and have still become wildly successful. Because when you are successful in whatever your idea, your product it tends to far outweigh any losses or failures that you've had. Peter Thiel has what he calls the power law, more commonly called Thiel's law, that it expresses this exactly, right? That a failure is actually very easy to quantify, but a success is actually more difficult to quantify, right? So if I say, hey, make an investment for $100, the worst that you could lose is $100, and it may be a little embarrassment because you picked a bad investment. But how much could that $100 turn into? $1,000, $1 million, $1 billion, etc. Much harder for the human mind to be predictive in that way. So I always encourage people to do that. How to do that? Right? Let's be granular here. I want you to whip out a pen and paper, not a laptop. You got to write it down, old school here, analog. And I want you to do a postmortem of whatever your idea and product is, whatever the thing is that you want to do, whatever the thing that you could fail at. And I want you to write down exactly a plan of what it's going to look and feel like when you fail. So we are going to plan to fail. If everything we possibly could do went completely wrong, the worst case scenario that there could possibly be, block that all out. Write it all down. How are you going to feel? Where are you going to live? What is that going to look like? That is fear setting, not goal setting. That is fear setting. Once you better understand the worst case scenario, you suddenly realize, oh, that's actually not that bad. Now I feel more prepared to A, problem solve any of those failures as they arrive before they get there, right? Because you've already sort of just pre-discovered them. But two, you've been able to do a risk-reward balance on, okay, what am I really risking? Not what is my mind and imagination thing, but what am I really risking versus what's possible, what's attainable. So fear setting, write it down, write down the worst case scenario. It's going to do two things for you. A, it's going to make you much better prepared to face those hurdles when they happen in real life. But two, it's going to set a much better expectation for you to be able to rationally take appropriate amounts of risk.
Fantastic. Well, Pierre, thank you so much. It's wonderful to have these interviews to talk about the issues, but also to have a real practical takeaway, some practical advice there to end on. I think that's a wonderful thing. So, Pierre, we thank you very much for joining with us today, and we appreciate your time coming on this SVIC interview.
Thank you so much for having me. It's been an absolute blast.
And to our audience out there as well, we hope you have enjoyed it too, listening to my conversation today with Pierre Rogers. Remember, if you have found it useful, you can check out our other expert talks we have online. You'll see the recording with Pierre up there shortly, as well as our past interviews and webinars that we've done. We also run a venture capital academy at Silicon Valley Innovation Center. So if you'd like to go deeper into the topics I've discussed with Pierre, and you want to see how this is all working in Silicon Valley today, do check out our website, SiliconValley.center. Do check out the website. You can find out more about the Venture Capital Academy and how you can sign up. It's still time for the next program, which is running in April. And so I think on that note, that's where we'll wrap things up. So from me, from my guest today, Pierre Rogers, venture capital investor and the founder of PuroTrader, we wish you a great day, and we'll see you again very soon. Goodbye.